Fed President Jerome Powell's optimistic words regarding a progress in Fed's inflation battle sent the US stock markets to fresh highs yesterday. Tesla jumped 10% while oil jumped on a surprise fall in US inventories. Now today, all eyes are on the US jobs data before July 4th break. So welcome. This is Swissquote's Daily Market Talk. So yes, Fed President Jerome Powell said that the Federal Reserve has made quite a bit of progress on inflation, and investors, didn't need more to jump back on the back of a bull yesterday. The S&P 500 closed at a record high yet again this year, while Nasdaq 100 hit the 20,000 psychological mark for the very first time in history. And this time, Tesla contributed more to the rally than Nvidia did, because Tesla shares jumped 10% yesterday after the company reported a smaller decline in quarterly sales than expected by analysts. In numbers, Tesla deliveries fell almost 5% in the second quarter, and they fell for the second quarter in a row, and not around 5.8% analysts were looking for. So I understand that a smaller decline or smaller than expected decline in deliveries leads to a price correction, but a 10% jump seems a bit overdone to me. Even more so, as Bloomberg also reported that deliveries from Tesla's Shanghai mega factory fell 24% last quarter, despite aggressive price cuts in China, which stands for about a quarter of Tesla's market share. We don't know how much of these Shanghai deliveries are actually delivered to the Chinese market, but overall, the news yesterday was not good enough to trigger such enthusiasm, in my opinion. Because Tesla sales accounted for about 50% of EV cars sold as of May in the world, down from 62% a year ago, whereas its competitors like BMW, Ford, Hyundai, Kia, Mercedes, and Rivian boosted their own sales by 50% or more. So this means that the growing competition in the EV sector will likely continue to squeeze Tesla's advance in this EV space unless the company finds something new to rely on. So in my opinion, the supercharger business was quite cool and promising, but Elon Musk decided to exit it. The robotaxi seemed to be the next big thing at Tesla, but there we are very, very far away from a mass adoption that could eventually boost profits in significant manner in the foreseeable future. On the contrary, this whole robotaxi projects will more likely boost spending in the first place than boost profits. So price-wise, Tesla is now in the overbought market territory, meaning that the shares have been bought just too fast and in a too short period of time, and a downside correction would only be healthy until the company announces its earnings in about 20 days from now and gives more details on its robo-taxi plans on August 8th. So let's wait and see and go back to the economic data. Now, on the economic data front, as I was saying, Jerome Powell's words yesterday determined pretty much, yesterday's market mood across the global markets, even though the man didn't want to give any concrete hint regarding whether the Federal Reserve would cut the interest rates in September. The US yields eased yesterday. They eased slightly, but they eased still, and the probability of a September rate cut rose slightly to 67%. The data, however, painted a mixed picture. Job openings in the US rose along with economic optimism, but job openings in the US private sector, for example, rose only 42,000 after falling nearly 500,000 in March and nearly 400,000 in April. So the aggregate 3-month average still showed a steep decline in the US job openings, and there's also this new idea out there that the US jobs market is now at an inflection point, and that fewer job openings will likely lead to a faster rise in the unemployment rate. So due today, the ADP report is expected to print 163,000 new private job additions in June. We will also have a look into the weekly jobless claims data today, as the US will be closed due to the July 4th holiday tomorrow. Overall, a sufficiently soft data from the US should keep the Federal Reserve, those in charge of the market, before Friday's all-important official jobs data. Now in Europe, news and economic data were mixed as well. Headline inflation in the Eurozone is to 2.5% level in June, but core inflation remains steady at the 2.9% level, disappointing those who were actually expecting a decline to the 2.8% mark. The lack of progress on the core inflation front in the Eurozone gave reason to European Central Bank Chief Christine Lagarde's cautious tone a bit earlier this week regarding the progress toward the bank's 2% inflation target. And obviously the rising oil prices these days, which jumped 15% since the June dip, will likely cause some headache as well in the coming months, because the barrel of US crude advanced to almost $85 per barrel level at yesterday's trading session after the latest API data showed a 9 million barrel fall in weekly inventories last week versus a 150,000 fall expected by analysts. And elsewhere though, natural gas futures extended their losses to below a major Fibonacci support this week, which is the 38.2% Fibonacci retracement level on February to June rally, hence stepped into the medium-term bearish consolidation zone. Now, NatGas's inability to gain further positive momentum last month is obviously some relief to the inflation worries across the globe, even though I think that a further decline looks like unlikely, as countries will be refilling their gas reserves into the fall months. In the FX markets, while the euro-dollar trades range bound within the 107 and 107.50 range this week. The French political shenanigans remain obviously in the headlines in Europe and should limit the topside potential into the second round of the legislative election in France that will take place this weekend. Sellers will likely sell into and above the 107.50 level, while buyers could buy into the 107 level on hope that the Le Pen majority worries are overdone at this point and that the French will somehow successfully prevent her from gaining an outright majority in the French parliament next week. And in all cases, we won't have a clearer picture on the euro's valuation, the euro's next direction before next Monday. So I think that this range-bound trading will remain in place. In Japan, the yen continues its race to the bottom. The dollar-yen is gently trending toward the 162 level, but the threat of direct intervention keeps the Japanese yen bears contained so far. Otherwise, shorting the Japanese yen would be one of the most obvious and promising trades out there. Therefore, any price pullback that we might see due to an intervention, for example, will be interesting for those who have the guts to go against the Bank of Japan's efforts to stop the bleeding in the Japanese yen without fixing its monetary policy problems, like in the longer run. Elsewhere, sterling doesn't really look like a currency that will undergo a general election in just one day. Cable fluctuates with global dynamics, and the sterling bulls remain calm and confident that a landslide conservative victory as soon as tomorrow could further boost gains in the British pound that has been shattered since Brexit. On the data front, the latest economic data from the BRC show that inflation in the British shops hit 0% for the first time since October 2021, fueling the expectations that the Bank of England will soon be rolling up its sleeves and cutting the interest rates to give a much expected and much needed relief to the British economy. The latter could actually limit the anticipated post-election gains that we might see in sterling later this week. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.